Have you ever looked at a market crash? I mean, really looked at it. It seems like total, absolute chaos, right? Just panic, fear, and a bunch of random noise. But what if it isn't? What if, hiding just beneath the surface, there's a predictable, almost physical law that governs the whole thing? Okay, let's get into this, because it's a fascinating idea.
So get this. Here's the core idea from a theorist named Jason Northrop. He argues that the market doesn't just resemble physics, it is literally governed by it. The exact same equation that describes how a black hole forms could, in theory, describe the 2008 financial crisis. I know it sounds pretty wild, so let's unpack how it's supposed to work.
So the key to this whole thing is a super famous equation from Einstein's general relativity. It's called the Einstein-Hilbert action. And this isn't just some random formula. For physicists, this is one of the absolute bedrock descriptions of how our entire universe operates. Okay, yeah, that looks super intimidating. Don't worry about the symbols. The only thing you need to know is what this equation does. Basically, it calculates a number called S, which is the total action. And here's the cool part. Physics tells us the universe always follows the path where S is perfectly balanced. It's not minimized, not maximized, just stable. The system always finds its natural equilibrium. And Northrop's big claim is that the market does the exact same thing.
So, how in the world do you get from curving spacetime to the stock market? Well, the trick is to break this big equation down into its 5 key ingredients. Northrop calls them the 5 independent faders, kind of like sliders on a giant cosmic mixing board. Let's go through them, one by one.
All right, fader number 1 is R, the Ricci scalar. In physics, this is actually pretty simple. It just tells you how much space-time is warped or bent at any given point. You know, the classic bowling ball on a trampoline analogy, that's R.
So what's the market equivalent? Well, here, R is stress. It's the tension, the growing gap between the price of something and what it's actually worth. Think about those insane PE ratios we see, or huge corporate debt levels. That's the financial field itself getting warped.
Okay, next up is fader number 2, X. In physics, this is easy. It's just all the stuff in the universe. Every particle, every star, every bit of energy, that's all bundled into X. So you can probably see where this is going. The market's X is the total matter of the financial system. We're talking about the sheer weight of it all, the hundreds of trillions in derivatives, all the leverage sloshing around the repo market, every dollar of margin debt. It's the system's total mass.
Now our third fader, C, is a little more abstract, a little more out there. In physics, it's basically a correction factor. It makes sure that your calculations still work even when the very fabric of spacetime is being bent and twisted.
In the market, C is the volatility surface. Think of it as the system's weirdness meter. It captures how the market's geometry gets all distorted right before a big break. You know, the VIX goes haywire, bid-ask spreads blow out, all those things that tell you something is deeply wrong. That's C.
Fader number 4 is B, the gravitational coupling constant. In the universe, this is a fundamental number that basically acts like the volume knob for gravity. It decides how strongly everything pulls on everything else.
And this is where it gets really interesting. The financial version of this is the interest rate environment. The Federal Reserve. They're the ones with their hands on that big volume knob. When they raise or lower rates, they are fundamentally changing the gravitational pull for the entire financial system.
And finally, we have A, the scaling coefficient. In the physics equation, it's just a simple number that helps keep everything in balance, the gravity side and the matter side.
So in the market, this translates directly to position sizing. A is that final balancing act. It represents how much capital is actually being put on the line versus how much risk the system can truly handle. It's the last slider that brings the whole thing into focus.
So you have these 5 faders, and when they all get cranked up to their absolute limits, the system hits a breaking point. But here's where the physics gets even crazier. The theory says that the crash isn't just a random collapse. It is a perfect, symmetrical mirror image of the buildup.
I mean, just look at this comparison. It's almost beautiful in a terrifying kind of way. During the buildup, you have all this leverage slowly, quietly accumulating. In the crash, you get a sudden, forced, brutal deleveraging. On the way up, volatility is crushed down to nothing. Then on the way down, it absolutely explodes. It's a perfect, haunting symmetry.
And according to the theory, this isn't just a nice metaphor. No, it's a structural constraint of the system. The total action built up on the way up must be equal and opposite to the action released on the way down. The system is literally forced to balance itself.
Now, okay, this is the point where we need to be really clear. It's super important to understand what this framework is and what it isn't. This is not some magic crystal ball.
Right. This is not a trading system. It is not going to give you buy or sell signals. And it absolutely, 100% cannot tell you the exact date of the next crash. What it is a diagnostic tool. Think of it like a weather map for systemic risk. It's for reading the atmospheric conditions.
And if we use it that way, and look back at 2008, man, the system was just screaming. You had record stress, R, with housing prices completely unhinged from reality. You had record matter, X, with a literal mountain of mortgage-backed securities. Volatility, C, was weirdly artificially low, and the Fed, B, had been tightening rates. Every single one of those 5 faders was pushed to the absolute max. From this perspective, the crash wasn't a surprise, it was a geometric necessity.
So this whole idea of ecophysics isn't exactly brand new. But what makes this theory so different is its approach. It doesn't look at the market from the bottom up, it looks at it from the top down. See, most econophysics starts with individual people, traders, investors, and tries to model what happens when they all interact. This theory flips that completely on its head. It starts with the master equation that it assumes governs the entire system, and then it just figures out where the market's variables plug into that universal structure.
And that leads us to the author's really powerful final point. The argument isn't that we need to invent a physics for the market. The argument is that the physics is already there, embedded in the fabric of reality itself. We just have to learn how to read the equation. Which of course leaves all of us with one very, very big question. If this framework is a real diagnostic tool, and we look at the values for stress and market matter and volatility and interest rates today, what is the equation telling us right now?